Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
This weekend, we have three Power Pack webinars. The first one is Beyond ESOPs, where we will talk about how you can create wealth for your retirement through your ESOPs. The second is a vernacular webinar in Tamil, where we will talk about how you can invest for your child's higher education. The third is FIRE with mutual funds, where we will talk about what FIRE is and is it difficult for you to achieve FIRE. If you are interested in any of the three, click on the description below to register.
Multi-asset investing has become quite popular in the last few years. You've seen a lot of mutual fund companies come out with NFOs in multi-asset and hybrid products. You've also seen your precious metals basket perform really well in the last few years. So investors have become a little bit more open to looking at asset classes beyond equity when it comes to wealth creation. But it's also an important point in time for us to look at some common mistakes that we must avoid when we become multi-asset investors. So let me walk you through the 5 mistakes that an investor should avoid making when it comes to multi-asset investing. Mistake number 1, chasing performance. When investors decide to work on their asset allocation, they're often reviewing how different asset classes have performed. The allocation of the flows go towards investments that have a proven track record. So you'll typically see investors decide to switch from fixed income to equity towards the end of a bull market. You will see investors jump onto the precious metals bandwagon after there have been 3 or 4 years of consistent performance. All of these actions can actually be quite counterproductive to wealth creation because you've missed out on the early phase of performance and you're catching only the last bit, which is typically followed by a down cycle. So we need to be careful in understanding and evaluating where we are in the cycle. Sometimes even after a few years of performance, there can be a long runway before that performance stops. So being aware of where we stand in a market cycle and participating at the right asset in the right time instead of just following performance or looking for proof is a good investment strategy. Mistake number 2, making tax-based decisions. When we decide to allocate investments based on tax benefits or only on the taxation rules, we stand to lose out on a lot of other things. So what are some of these things that we might lose out on? Today we know that fixed income has a relatively unfavorable taxation compared to other asset classes. A lot of investors are moving out of fixed income into equities or precious metals or even arbitrage. But each asset class actually comes with its own merits. So if we look at what fixed income has to offer, it can offer more steady returns, it can offer more liquidity, and it can offer income in a steady manner. This is not something any other asset class can do, and each asset actually behaves in a very unique way, and we need to learn to respect that and find its role in our portfolios. So asset allocation decisions actually have to be more merit based than tax based. Sometimes tax is not the most important thing in optimizing your portfolio. Mistake number 3, ignoring sub asset classes. So while we talk about asset allocation, mostly people keep it at a high level, trying to look at say equity, precious metals or fixed income, but there can be sub asset classes as well. So what do we mean by this? When you say you should have some equity exposure, we can ask more questions like, should we be investing in large caps, mid caps, small caps, or should we be investing in domestic equities or foreign equities? So these are sub asset classes within the broad asset class of equities, and these kind of sub asset classes exist for all the bigger heads like fixed income as well as commodities. Sub-asset classes actually have the power to change how our performance and portfolio stability is, because you might always find more attractive valuations in a specific area of a sub-asset class rather than the overall asset class. So for example, if we look at where Indian markets are today, You might find relatively better valuations in large caps than in mid and small caps. Of course, there can be select opportunities in mid and small caps where a more bottom-up approach is being followed in security selection. Mistake number 4, having fixed targets. One very popular multi-asset portfolio strategy has been the 60-40 portfolio. So the idea is that you invest 60% in equities and 40% in fixed income, and that portfolio was supposed to weather all market conditions. But what we saw during COVID and after that was that the 60-40 portfolio actually doesn't work very well in a high inflation environment. So keeping a more open mind in terms of asset allocation and weights and being open to having multiple asset classes in your portfolio is what makes multi-asset investing very effective in different macro environments. Mistake number 5, inadequate liquidity. Do you know somebody who is asset rich and cash poor? This means they have a lot of wealth in their names, but they are unable to access it when it matters the most. When we follow a multi-asset approach to investing, we need to be careful about how much we are allocating to each asset class, but also how easily we will be able to access our savings when we need it. After all, multi-asset investing involves a certain level of rebalancing and shuffling of assets over a period of time. In Indian households, we have this tendency to lock up a lot of money in illiquid asset classes like real estate, and we may be under allocated to liquid asset classes. This could be investments in the form of mutual funds, stocks, or even fixed deposits. The other thing that investors tend to do is they might have a lot of illiquid assets and then other assets which are not really growing to beat inflation. So this is a fine balance that an investor needs to strike in terms of looking at multiple objectives, which is portfolio stability, beating inflation, and being able to participate continuously in their investment journey. Multi-asset investing could work for a variety of people, and there are many things that we need to pay attention to. If you think there are other common mistakes in multi-asset investing, let us know in the comments below.